Good afternoon. We had a break last week, and we are continuing our discussion with respect to economic analysis of financial regulations. And in fact, we briefly touched upon the broader picture in our discussion, where we have discussed about the concept of too big to fail, which has correspondingly increased the consideration in terms of moral hazards, and also the relevancy of the financial intermediation not being looked from efficiency considerations. And because of this reason, you probably find that the market participants, as well as the agents, principal agent problems that we were having, all being kind of brought into the equation. So this has created the so-called too big to fail is also a consideration in the form of a government safety net. So the government safety net also kind of contributed indirectly to financial consolidation, where smaller financial intermediaries have been brought into the picture, and thereby smaller financial intermediaries being asked to consolidate mainly to increase the efficiency, but ultimately that indirectly contributed to creation of too big to fail intermediaries. And this is a consideration not only in emerging market countries experienced during the so-called great financial crisis in 2008-9 and there onwards, and even in today's context, a lot of countries are experiencing consideration in terms of where to pinpoint the consolidation efforts, whether to increase the efficiency, whether to facilitate financial intermediation performing in terms of how best they can fit ideal resource allocation in financial market. But then the so-called the too big to fail continue to remain. So there are a lot of consideration built with this in the form of these agencies, the big agencies created through a consolidation, or in other sense, even challenging the regulations or the supervision that was established to bring betterment to the financial markets. Then you looked at asset restrictions on asset holdings, where I was mentioning the regulators bringing discipline in the form of what type of assets the banks or the financial intermediaries can hold in their portfolio, and even to the extent single ownership limits being brought in. And then the capital requirements, the minimum capital requirement, then risk-weighted capital requirement. So these were the direction in which the regulations was moving in recent times. And then you also looked at so-called the capital requirement in the form of government imposed, that is the minimum required capital to obtain licensing in financial markets. So this is available in the lecture lecture notes that you already have with you, right? So you see to the extent of the capital requirement, where the regulators themselves bring in the minimum capital requirement to license, to extend license for certain type of activities, especially when you wanted to have a licensed commercial bank, licensed specialized bank, or for that matter, a leasing finance business, or for that matter, a primary dealer operations. So you need to bring in a minimum capital. So this minimum capital is brought into kind of, bringing some element of ownership obligations to the organization, and through which some minimization of moral hazard. Moral hazard is you are basically taking beyond your allowed risk allowance. So you are confident that somebody else is looking after you. So when you see somebody else is looking after you, you take risk beyond your capacity. So that itself would jeopardize, if not bringing indiscipline and risk to the entire financial intermediation, right? So the capital requirement act as a buffer where the ownership investments have some element of controlling the extent to which that you are exposing for additional risk. But then these capital requirements also expanded in recent years based on two forms. One is the leverage based, okay? So the amount of capital, you look at the leverage ratio. So you look at the amount of capital divided by bank's total assets. So if the bank's keeping a huge amount of assets and the capital share is small, that means your leverage ratio is quite large. So you look at it like you are expanding beyond the capital scope, right? So you see to be classified as a well-capitalized financial intermediary or a bank, you have different leverage consideration. This varies from country to country, but as a rule of thumb, you can say a bank's leverage ratio must exceed 5 times. That means a capital base should at least be like 1/20th of the organization's asset base. Okay, so if it is more than that, it's good. You have a higher leverage. That means 10%. That means capital is 10% of the organization's asset base. Okay, but when the leverage ratio reduces to smaller numbers, so like 3% or lower, then you are in a kind of a risky circumstance where you are much more exposed to assets that you are holding, but actually you are not necessarily bringing in ownership capital. Okay, so then the regulators will bring in some discipline and regulatory action with respect to these agencies. So what you are basically seeing is some discipline in terms of minimizing moral hazard in the form of capital requirements being imposed. And the second type is risk-based. Yes, you have no restrictions of asset holdings, but then when you hold certain type of assets, you require to bring in more capital, right? So that means to say that the financial intermediaries could expand themselves into risky avenues, riskier ventures, but then that riskier ventures has to be supplemented with the adequate capital base. So that's the risk-based capital requirements that they are looking at it. So for instance, if their asset base is quite significantly expanding into, let's say, government securities, those are often zero risk weights. So there's no necessity to bring in additional capital because they basically see government securities are risk-free. In principle, it's default risk-free. Okay, so when it comes to such assets, you might not necessarily bring in capital and additional capital. But if you are expanding into, let's say, real estates, you are expanding into trade finance, you are expanding into corporate finance, where the corporates being highly leveraged into certain economic activities which are seasonal, volatile, then of course you require to bring in additional capital. So there's a way in which the organizations look at this, and the financial intermediaries look at it, and regulators follow on that basis. So you see this hype in terms of capital requirement. One is in the basis of leverage arrangement, leverage ratio based. Other one is on the basis of risk-based capital requirement. So that to say that, yes, the financial regulator is not going to stop you from taking risky assets into your portfolio, but you should build bases. You should build bases in the form of capital. So you enhance the capital, then you can have more riskier assets in your portfolio. So to say, to bring in kind of discipline into the market. So see, I mean, these are the ways through which the moral hazard behavior could be to some extent minimized. So this is expanding into further layers of risk assessment in recent times. We will get into those stuff as we move on in this discussion. And as I always mention to you all, if you see that you wanted to clarify anything, you wanted to have a discussion on any of these things while we are going ahead with the lectures, you can raise any questions. You can put down your questions, your clarifications, your observations, so we can follow it up. Okay, so you can send that through the chat mode, so we'll be able to follow it up on that basis. So you see this element of capital requirement. So then you see supervision is extending into so-called chartering and examination. You see, financial supervision is often conducted by financial regulators. So most of the countries have their central banks, and the central banks do the regulation. But sometimes in some specific or special cases, you have so-called FSAs, Financial Services Authorities. Okay, so some countries had FSAs in place of central banks handling supervision, but subsequently they have moved back to the central bank again. For instance, UK. Initially, it was the Bank of England, but then they had the FSA. But after the financial crisis, again, Bank of England took over the financial supervision aspects. But interestingly, so-called chartering and examination has now built into each and every examination supervision carried out by the financial regulators. So when it comes to chartering, what it means is they screen proposals to open new financial intermediaries. Okay, so this is to prevent so-called adverse selection. You know what adverse selection is, right? So to avoid you are picking an institution as a financial intermediary, you don't want it to make a mistake. So you wanted to make sure you are doing a right screening, the proposal of this financial, a new financial intermediary. So when they apply to the regulators with other requirements, right, there's a process through which they screen these proposals. They screen under various circumstances and under various requirements. I mean, that includes a lot of things listed out in the examination part of this. Okay, so the screening process would shape whether the financial intermediary that the regulator is going to license is capable enough and their proposals are sound enough in line with the economic and financial viabilities. So this is a very, very important aspect in today's context. This could be a conservative screening process as well as dynamic screening process in today's context. Conservative is very much established, like for instance, if you are applying for a job, you will be asked to provide referees. So you do a kind of a screening through referees. That is one way of conservative screening process. So that's a more kind of established all and everywhere. But dynamic screening processes, that includes even running models, okay, financial models with respect to the financial proposals of these agencies to see whether the proposals that these institutions provide is viable given different economic circumstances. So they look at those, okay? So they look at these things with different perspectives, and then you look at examinations, okay? So the supervision continues into chartering and examination. So when it comes to examination, this could be scheduled examination, like you see you have periodic exams at the end of the semester. So it is scheduled. And unscheduled, it's ad hoc. You walk in at a discussion and you've been asked to sit for an examination. So it's like that when it comes to financial intermediaries also. So this examination could be scheduled, unscheduled. So to monitor capital requirements and restriction on asset holding to prevent moral hazards. This is examination often takes place after licensing. Okay. So this is after the transaction or after the license has been granted. Okay, but chartering happens to avoid adverse selection. That means before the license being offered. So you see the difference between chartering and examination, and this chartering and examination again inbuilt through, as I have already mentioned, both conservative dynamic processes. And examination in the form of scheduled and unscheduled is very common in today's context. So these examination look at so-called capital adequacy. So you have a minimum capital requirement, as I was explaining in the previous slide. So you should have this much of minimum capital to start a financial intermediary. But that is not what everything in terms of capitals. But subsequently, when the business expands, the financial intermediary take up new assets and new ventures, their capital requirement also expands. So on a periodic basis, regulators would look at their capital position. They look at this capital from a very broader perspective. And also they look at the assets this financial intermediary hold in its portfolio. How much of assets in government securities? How much of assets in quality loans? Right? How much of assets in so-called subprime loans? How much of assets in one type of loan category like agriculture? How much of assets in international trade? How much of assets in gold? I mean, you can go on. You can look at the assets of these institutions. And they look at this through examination. And then you also see the management. Okay, you know, board of directors, they need quite to get the clearance of the regulator on a regular basis. So-called fit and proper assessments of management. Fit and proper is whether you are physically fit or not. It's not what fit and proper analysis is. Yes, it's important that you are physically and health-wise also sound. But fit and proper mainly refers to your the trustworthiness and your creditworthiness in terms of how to handle very senior position in financial intermediaries, right? So you have to have the established reputation. If not, they are mindful whether you are a tarnished personality. So you are not necessarily have a good track record in the financial industry. So they keep all these before giving them the clear green light to operate. So this management examination is also very important. Board of directors and senior positions of all financial intermediaries have to get the clearance of the financial regulators to make sure they are very sound and established and with required capacities, including sometimes the professionalism and other required yardsticks established by the financial supervisor. So this is very important. And also they look at the earnings, right? So how the earnings are from conventional, or it's based on fee-based activities, or whether conventionals are often the margin-based. Fee-based is today more or less dynamic activities that the financial intermediaries engage in. And then how the earnings being kind of maintained all throughout, whether there is a pattern of earnings volatilities, whether all earnings being distributed across, and whether you are required to keep part of your earnings for years or periods where you don't have good economic circumstances. So these things being analyzed. These things being looked very seriously by the examiners. Okay, then they look at the liquidity. Okay, you have the portfolio. How much of this you require to maintain in liquid form, liquid assets, because you probably see banks required to honor their obligations to depositors on a continuous basis, or even for the people who has assets there, and then they have to honor their obligations, right? So these things being looked at in the form of liquid assets ratios. They look at in the form of how much of the assets being maintained, how much of currency being maintained. So these are very, very important yardsticks through which financial institution or intermediaries health being assets by examiners. And then also you look at sensitivity to market risk. So what happens if interest rates increases? You give a shock. to your portfolio. So you have all the assets in your portfolio that you are holding, but when it comes to interest rate shock, what happens to these assets, mark-to-market prices, when the interest rate increases, you know what happened to the asset price? Asset price decline. So when the assets price decline, when interest rate increase, what happens to the organization's portfolio? Similarly, exchange rate risk, right? So if you're holding assets and liabilities in foreign currencies, right? So what happens to the exchange rate behavior? So when exchange rate being depreciated by 5%, when exchange rate being appreciated by 2%, you will give a shock and see whether the organization can absorb these shocks is a very important yardstick. And if not, regulators might require these agencies to trim down excessive risk in certain areas of asset classes, certain areas of liability classes the financial intermediary is carrying on. Okay, so then they also look at these examinations through filing periodic call reports. You may have so-called on-site supervision. You may have off-site supervision. On-site is you physically visit. Regulators physically visit to the financial intermediary and clarify their books, clarify their positions, and then look into those details. Even they would ask you to provide the deal tickets if you have done transactions. The deals you have executed, they might ask you to see what's the underlying correspondence, what's the underlying authorizations, how the firewall's been established, right? Firewalls in the form of front office, back office, middle office operation, settlement operations. So this is very, very established processes in all organizations. So this on-site carries out such activities, while off-site is often you've been asked to provide details through established formats or other to the financial supervisor. So you had to provide monthly, daily, weekly, and quarterly and annually. So these information's been called by the supervisors, and these reports been evaluated, examined, and they follow up. So these are very important elements that you see in terms of financial supervision, chartering, and examination process. Any questions? Right. So you see these details, and then you see also assessment of risk. Risk management is a very important area of financial intermediation in today's context. Today, the risk evaluation and assessments are in all aspects of financial intermediary. So it's not only the assets that you hold, even the risk elements of your people that you find working in your organization. And now, on top of that, possible risk assessments in the form of possible diseases, pandemics like COVID. Now everybody is exposed. And also they look at so-called DRS, disaster recovery site arrangements, DRS arrangements. So what happened if all of a sudden a blast like what you see in last week in Beirut in Lebanon happened? So what happens to your businesses? What happened to your financial intermediary? What happens to your obligations to the rest of the world? Whether you can open and continue your operations underground, whether you can do your operation from somewhere else in the country. For instance, Central Bank of Sri Lanka had a terrorist attack in 1996. So then how quickly they got back to their feet and started continuing their operations, right? Even during lockdown recently, they were working on a continuous basis from remote arrangements or from their main head office or from disaster recovery sites. So how all these things been looked at? So these are part and parcel of risk management in today's organization. Okay. So here the risk assessment also emphasizes evaluating soundness of management processes for controlling risk. This is to avoid so-called fraudulent possibilities, because you don't necessarily establish. Sometimes you might see the management processes in terms of limits being established. You can't go beyond, let's say, 50 million in terms of transactions. If you wanted to make that call, you had to go to the higher senior management's approval. If it is 100 million or more, it is the head of the department or the CEO's approval. And if it is more than particular value, like 200 million, it's board of directors. So that's way in which the management process is established. And also there's firewalls. I was mentioning firewalls. You separate front office to the back office, because front office that engage in transactions, back office do the settlement. So they try to create a firewall where the front office and back office do not cohabitate in the form of having a collaboration in the transaction. So they establish these firewalls to avoid the possibilities that the risk aspects being breached. So you see different arrangement in the form of trading activities manual of US, but you don't need to worry about the name of the manual. You can look at risk management or risk assessment based on that manual is established in the form of certain yardsticks, the quality of oversight, how the assessment being carried out in the form of how the quality of arrangements being established in the organization, how frequently the yardsticks being looked at, how frequently the yardsticks being revisited, right, improved, and bringing in changes where matters, right? And then, of course, the adequacy of policies and limits for all risky activities. You, as I mentioned in treasuries, you probably know there's limits for transactions. Dealers can make on their own, as I was mentioning, up to, let's say, 50 million. So the levels being established. Okay. So if anybody is breaching that, whether it's with approvals or whether it's a kind of a regular practice, so it's a very rare. And subsequent arrangements have been there in the form of higher authorization arrangements. The head of treasury, then of course the CEO, then the board of directors, or even for that matter, if a very serious decision has to be made, extraordinary annual general meeting, even that's required. So you look at these policies, systems, and firewalls put in place. So that's a yardstick, and through which you assess the risk of financial intermediary and then give them the rankings. Okay. So then you also look at risk measurement and monitoring systems, whether your systems are easily adjusted and whether these systems are manually kind of changed, or whether these systems are password protected and controls established, and the all attempts being recorded in the form of follow-up audits and things like that. Okay, so they are looking at all these things and the internal control arrangements, right? So compulsory leaves and controls in the form of the same parties, like the people who are of same household or close relatives been working in the same arrangement within the organizations. They look at all these things to avoid possibilities of risk, and through which the organization's credibility and possibilities of fraud being addressed. So this is the way in which today the assessments of risk being carried out by most of the financial intermediaries. And then you see the processes that you establish in the form of interest rates, risk limits. Okay, so interest rates within 50 basis points you've been allowed. 50 basis points means a half a percentage point. Within a certain level you've been allowed to make decisions. If it is more than 50 basis points, you require to bring in a so-called decision-making authorities lined up in the organization in the form of committees, in the form of required approvals, okay, in the form of justification and also for that matter possible yardsticks to kind of a measure what's the outcome of such decisions. Okay, and then of course management and monitoring is again there. Whether you have recordings within the organization, if it is dealing room, you have voice recordings, you have now picture recordings, CCTV arrangements, right? And then you see whether you have forensic arrangements to follow up. So all being looked at. Okay, and then now you are going beyond that and you look at stress testing and so-called value at risk VAR and things like that. So you do different type of the assessments through various models. You give a stress, you see what happened to interest rates, what happened to exchange rate, what happened to the personal aspects being addressed, where the chief dealer being asked to completely keep away from engagements for a period of 2 weeks or so. So he doesn't have any access, and without his access, everything being tested again. And whether it's been a personal risk, how one particular person is making all the decisions, or whether it's been distributed across, these are all kind of, you know, risk assessments are now in financial intermediaries to bringing much more discipline and orderliness in the organization, and through which they can give the rankings to financial intermediaries. If they find the rankings going below a certain yardstick, they've been asked to bringing at least the minimum standards of requirements. So the minimum standards of requirement, all financial intermediaries required to follow. So these were the kind of, you know, arrangements that they have put in place in organizations. So you see this type of arrangement if you are working in these organizations, financial intermediaries, in the treasury mainly, or even for that matter, you are in corporate finance. Okay, so you find these assessments, and even counter staffs have risk assessments arrangements in today's per se. So you see this type of developments across all financial intermediaries, and you can see these details also from a perspective of disclosure. You have to disclose. Financial intermediaries have to disclose their activities. So you have requirements. Okay, so if you are a listed company, your requirements are different to non-listed company. Okay, so when you see it is a family-owned financial intermediary, your requirements are slightly different to a public-owned, right? So then you see a requirement in the form of single ownership and things like that. So that establishes that one party or one particular interest is holding entire organization's decision making. So there are various ways through which these requirements for disclosing the details being looked at. So why all these things? These disclosing requirements coming to kind of, you know, reduce the asymmetry. So you all throughout seeing this asymmetry is one of the biggest drawbacks in financial intermediation. So you reduce the asymmetry by bringing in this type of disclosure requirements. So these requirements to adhere to standard accounting practices. I mean, you can have certain type of bookkeeping, but these accounting standards across different periods, across different countries, you need to have the standard. Otherwise, what happens is you may come out with the profit where the different treatment of information would result in that profit being wiped out. So it's not right. So that's why the international practices requires best standards of accounting principles being followed, and this requires certification by international organization, and these organizations look at it in the form of accounting standards and accounting education system being standardized all throughout the world. So that's bringing discipline, and that this discipline bringing sort of, you know, evaluating things of the apples versus apples, not apple versus oranges. So you see these requirements being brought in, and this help to compare details, compare assessments, and also to disclose information in a wider sense to reduce the asymmetry. And then you see Basel. There's Basel Accords, Basel II, Basel III. It's expanding. I mean, this is a place in Switzerland. I mean, they have the financial regulators meet and they discuss and they bring in new assessments and requirements in the form of financial intermediary evaluation. So they bring in so-called Basel Accords and SEC means Securities and Exchange Commission details. They bring in different disciplines into these disclosure arrangements based on market developments and expanding a role of financial intermediation in the world and through different experiences of different countries. And you don't need to worry about these the Auxiliary Act and things like that. But what matters there is that establishes, okay, some oversight committees, if not oversight boards, to see whether the practices of disclosing information is standard. And that requires the attention of this type of oversight boards. And that brings in the minimum acceptable standards for financial intermediaries in the form of disseminating information and disclosing information. And then, of course, the accounting principles. You may just buy an asset and keep it until maturity. That means you are not necessarily looking at that asset for trading. You are basically looked at that asset as an investment. So investment portfolio would not require to mark to market your portfolio. Mark to market is you are pricing every day your asset based on the prevailing market prices. When it's interest-based assets, it's very easy. Exchange rate assets, it's very easy. Okay, there may be certain assets that you hold, you might not have a readily available market. So how you are doing the mark-to-market pricing? So these are all kind of details the financial intermediaries look at, and they try to kind of bring in this into their portfolio, into the books of these intermediaries, and they assess the level of risk that these agencies exposed to, right? And also these information required to be disclosed on a periodic basis. Even if your investment portfolio is not necessarily exposed to market risk, day-to-day fluctuations of interest rates and exchange rate, but still at a given point of time, you know where you are sitting in the form of your asset valuation. So this requires to be bring into the books and show it to the general public in the form of disclosing, and thereby creating a much more information symmetry in the financial intermediation and this decision making. And then now you see this is expanding to the extent where consumer protection, right? So consumer protection is a very familiar and very simple a word in goods market, services market, but that's now coming into the financial intermediaries also. In the financial intermediation, in the financial market, also they look at consumer protection, and even now the financial regulators like central banks are establishing different departments to look at consumer protection. Even Central Bank of Sri Lanka is establishing a department on 10th of August, that means on Monday, right? For the purposes of financial consumer protection, right? So this is expanding all throughout in the world. And these bills or acts that you are seeing, you don't need to worry, but you need to kind of get a feel that these are newest addition to the financial intermediation and financial regulation, simply because through which the further enhancement of consumer protection, consumer safety, or the customer investor safetiness is being established. So this is what you are seeing from all these details. And this again, the financial crisis we discussed, where the subprime mortgage crisis kind of opened up new avenues for consumer protection because of the volatilities and the underlying risk of financial transactions carried out during that period. So you see how vast the environment is in terms of financial markets expanding now. So you can figure it out, and these details to great extent in regular financial press in today's context. Okay, so questions? Any questions before I move on to clarifying these competition related restrictions? Right. We can move on. We can move on and discuss the restriction on competition. And you see here, now this competition is again bringing a so-called efficiency, right? So everybody wants to see a competition being enhanced. Through this competition, what brings in is a much more efficient outcome, right? But unfortunately, when it comes to financial industry, financial intermediation, financial market, this increased competition at times also increase so-called moral hazard incentives. Okay, so that means you are going to take more risks than what you used to because of this competition, right? So it's like you wanted to drive fast. You're competing against your other market participants or other institutions. So you want to drive fast, but you are exposing yourself for more risks. But if you have an insurance, probably you would not worry about that insurance. Even if there is an accident, you know you have the cover. So it's like financial intermediation. In the financial intermediation, you expose yourself for more risk and competing aggressively without correspondingly looking at the firewalls, yardsticks that's been established to protect the original investments, if not the lenders who have exposed their assets into the financial intermediation. So you have obligation towards the assets that you are holding, but at the same time, the liabilities in your books also matters. So the liabilities are the ones source funds to invest in assets. So you need to kind of take adequate competition, but not necessarily increase competition in financial markets. If the increased competition being allowed, of course, you see you are enhancing moral hazard incentives too. So there are a lot of details here. So there may be circumstances where the financial intermediary is being restricted to open branches. Branching is good because you are taking the banking to the your doorstep. No, I think it's now been changing. So branching is good for the people to have easy access, but with the other developments, you can go into so-called much more efficient and faster banking arrangements and financial intermediary arrangements through a wider access arrangements through online now. You don't need to kind of physically establish branches and thereby create additional cost elements, right? So there may be a lot of competition in expanding the bases, but unfortunately, expanding the bases without having efficiency limits is not necessarily advantageous to the financial intermediary. So you bring in restrictions and to kind of put brakes to the speed in which that you are driving. So this justify you are not necessarily contributing to moral hazard incentives. So this is why the competition being looked differently in financial markets. And of course, as I was repeatedly mentioning, the restricting competition also has disadvantages, because you can say that would contribute to higher consumer charges, decrease efficiency. Yes, there's a possibility, but now in today's context, these are increasingly shrinking its importance, simply because restriction of competition do not necessarily try to kind of restrict the efficiency related competition, but often the risk related competition only they've been looked at. So they wanted to address anybody's excessively taking risk, competing and taking excessive risk through various arrangements. So that's what the financial regulators are trying to address in today's context, rather than efficiency related restrictions. No, they are trying to increase the efficiency through various enhancements and incentives. Okay, so you have to try to understand the distinctively understand and recognize what these restrictions that they are talking of. It is not of efficiency related, it is of risk related. Okay, so they wanted to see unnecessarily exposing competition and through which exposing to risk being looked at, and thereby moral hazard behavior being minimized. So that's what the restrictions are broadly looking at. Okay, but more interestingly, in today's context, today's financial regulation is fashionably moving into macroprudential supervision against conservative microprudential supervision that was practiced. Macroprudential versus microprudential. Micro, individual, institution specific. Macro, not individual, not institution specific, but broadly the market of not economy-wide assessment of potential risks and other elements. So what matters is, at times you probably see a single institution would not necessarily be that big, but in its books he is exposed to higher element of risks. He has loaned very much to the agricultural sector. So when there's a flood, when there's a drought, agriculture get hit. So that institution is in trouble, right? So that is a micro. But what you are simply seeing is macro, is whether the entire financial industry is too much exposed to agriculture during flood period, during drought period. So what happens then is entire financial industry is in a mess. So that's what macroprudential is looking at. Okay, so there's a distinction between micro and macro. So before this financial crisis that we were discussing in our previous lectures, most of the regulation, if not regulatory authorities, engage in so-called microprudential supervision. Okay, so microprudential is focused on the safety and soundness of individual financial institutions. So that is also important. There's no argument that microprudential is not important. That is important. But the focus there is often about the individual institution and or a segment of institutions, not industry-wide. Okay, so that is microprudential supervision. But global financial crisis made it very clear that there is a need for macroprudential supervision, which focuses on the safety and soundness of financial system in the aggregate. So it is like microeconomic versus macroeconomics. Macroeconomics is you study the economy as a whole. Micro is segments that you are looking at, right? So macroprudential supervision, which focuses safety and soundness of the entire financial system, look at whether the financial system is exposed to possible potential risks, right? So if that's the case, they would bring in a lot of measures to address them, because that's very important. If anything happens to exchange rate, if everybody is exposed to foreign borrowing, right? So then there's a problem. Your balance sheets would get really hit when the currency depreciates. And also they look at aspects where the economy is not growing at usual pace. All of a sudden it slowed down. What happened to the portfolios of these institutions? Maybe one institution is micro supervision, fine, but as a whole, entire industries exposure to certain type of lending. That lending is not necessarily performing now. What's going to happen? Okay, so these are the things broadly the macroprudential supervision is looking at. Microprudential supervision, it is very important. There is no argument with that. But they focus safety and soundness of institution, individual institution or a segment of institution, fine. But macroprudential, that focuses on safety and soundness of entire financial system in aggregate. That shows the kind of, expansion and importance that the financial crisis has brought into the financial market and regulations. Okay, so when they recognize the fact that the entire financial intermediaries are exposed to so-called subprime mortgage loans in US, they recognize that addressing the problem of one particular financial intermediary, okay, Lehman Brothers for that matter, would not solve the problem of financial crisis that the world has experienced, right? So then they're required to bring in much more wider economy-wide measures. So that's what they have brought in. They have pumped in, they have facilitated asset purchases, liquidity measures, quantitative easing, all what we discussed during financial crisis discussions is about addressing the problems in aggregate. Okay, so financial crisis, another good lesson is that they have differentiated individual institution specific problems to industry specific, market specific aggregate problems, and contributed to introduce or prioritize macroprudential supervision over microprudential supervision. Okay, so this is also a newest direction in regulation, financial regulation. I already mentioned for you to kind of, consume what is the consumer protection. And then you see the competition, restriction on competitions. The competitions is not necessarily efficiency competition restrictions. What we were discussing is the restriction in the form of risk-related competitions. Now we are looking at a microprudential versus macroprudential supervision, right? So these are the elements that you have to take from these discussions and try to kind of figure it out where the developments are heading, right? So you see these elements, and I just list down some of the legislation in US case, but you don't need to necessarily look at these legislation seriously, because these legislations are giving you some insights into how US was bringing in a lot of new changes to the financial market and financial industry in recent times, and subsequently to the financial crisis, also it's expanding on a continuous basis. Okay, so there's reforms on a continuous basis, and they have been brought in a lot of arrangements to bring in a new discipline and new consideration in the financial industry. And specifically, you look at a few US experiences since Oaksley Act in 2002, you probably see new elements also coming into play. So that would give you some insights into how these markets operate. So you have any questions? Right. So we can move on. We can continue our discussion. So you see here the different elements of bank failures that has happened in US. And interestingly, you can see with all these regulations, with all these measures being put in place, the number of bank failures also not necessarily diminishing. It is continuing, and even in the future, there is no guarantee that banks would not fail, right? So what matters here is to minimize the repetition of these bank failures. And you'll probably see from Second World War to early 1980s, you might not necessarily see much failures, but since early 80s again until early 90s, you see subsequently, substantively high number of bank failures. This is in US, not across the globe. So you see in US, the banks had difficulties at different times due to various reasons. So the regulations would try to address and try to prevent this type of financial distress. And then again, you see during the financial crisis, it increases and then it gradually reduces. Now we have to very carefully navigate through this COVID period. So the financial regulators are very mindful, and the governments are very mindful, authorities are very mindful to see that the problems of financial intermediaries and the financial markets being looked at very closely and collaboratively to avoid repetition of problems in the financial markets. And also, you can see here again in the form of the total assets, okay? A number of bank failures in the red, and total assets during this period of failures in green. You can see at different period of time up to 2019. This is in the new millennia, 2001 and 2019 period. You can see the numbers here, right? Numbers have very much reduced from a peak of 157 in 2010 to almost 4 like in 2019. So the bank failures have, in absolute sense, have come substantially to a very low level in recent years. But at the same time, you see the assets of these the financial intermediaries who fail. Okay, in 2008, it crosses to almost 373, actually $374 billion. And then it comes to a very small number, 214 million. 214 is 0.2 billion in 2019. So you see the problems have to some extent been addressed in recent times, but there is no guarantee still the banks would not fail. But what you are simply seeing is gradually the repetition of banks failing and the assets being exposed is reducing in recent times, because there were various measures being put in place collaboratively by agencies. Interest rate being substantially reduced, so the banks would not necessarily face difficulties in accessing liquidity support arrangement by the central banks, and asset buying arrangements being introduced. So all being introduced to kind of ease the pain of financial intermediaries, and also to some extent with the deposit insurance arrangement expanding. So people are not queuing up in front of financial intermediaries to take their money out. So these are very interesting information for you all to kind of analyze and see. And then, of course, there were different crises at different periods. Okay, so you see in 80s, more or less the crisis was saving and loan and banking crisis. That was the period where I was mentioning in the previous slide, this slide, the number of banks failed in US, and of course, the assets being not listed here, assets also would have been significant. So during this period, the troubles were mainly in the saving and loan banking institutions, financial intermediaries in the US. Okay. And this is the period where you are gradually moving into new financial innovation and new financial instruments like derivative products being introduced, and financial intermediaries also started taking higher risks. So that was the period where US also then had the problems of higher inflation with oil price shocks and things like that, right? So this would have really pushed these agencies into red. So that's why the failures refused in high numbers in 1980s. And also during this period, moral hazard, because people have started moving into deposit insurance. They were not worried too much what their financial intermediary is doing. They're not worried whether they are taking risks beyond what they should be taking, and they were basically relying on, okay, if anything happens, I have my insurance. So that's the moral hazard behavior. So that also contributed to some of these failures. And also during this period, some deregulation. You felt that the regulation was too stringent and too tight, so they wanted to reduce the regulation. So that has opened up again a much more relaxed environment for financial intermediaries to operate. Maybe some relaxation in terms of chartering and examination processes. So this would have contributed to higher failures in 1980s. Okay. Then subsequently, they looked at these developments and brought in much more discipline in the form of reform, recovery, and enforcements. You don't worry about the act referred here, but what they wanted to see is reform, regulatory, and enforcement arrangements. And also, they have brought in Deposit Insurance Corporation and Improvement Act. Okay, so to see that bailouts being reduced going forward, but still the bailouts during this period through deposit insurance arrangement in US was costly. It's about 3% of US GDP at that time, right? So 150 billion is 3%. Sri Lanka's economy is only about $90 billion. Okay, so you can guess that's in today's Sri Lankan economy. In 1991, it would be in early, I mean, it may be in 20s, 20 odd billions, if I'm not mistaken. You can compare, I mean, the sizes of these deposit insurance packages being used to bail out some of these agencies during that period. Okay, so while these been introduced after 1980s, early 1980s, towards latter part of 1980s and 90s, you have introduced some of these arrangements to enforce, recover, and reform. But banking crisis again started towards middle part of 2000s. Okay, so it's all over again, deja vu, right? So it's all over again, and in the period before this, not only in US, but there were other places like Japan had difficulties in late 1990s and early 2000s before the US had this financial crisis related problems. Okay, so this nervous cycle of financial crisis, banking crisis all around the world, there you don't necessarily blame the deposit insurance. Okay, there are other elements. In fact, deposit insurance is good that try to kind of avoid people queuing up and try to withdraw their deposits at once because of the cushion deposit insurance has brought in. But the common feature of most of these crises in recent times is moral hazard because of the government safety nets. Okay, where governments stand ready to bail out troubled financial institutions. So the troubled financial institutions do not necessarily take adequate measures to manage their financial intermediaries properly. So this is something you see quite challenging in today's context, because now the COVID-related developments also bringing in a lot of requirements on the part of regulators. The governments are pushing the regulators to take certain measures to facilitate financial intermediaries, but effectively that enhances the moral hazard behavior. So it's a fine line between kind of facilitating and not letting moral hazard incentives. So you should be able to kind of, you know, answer to that type of elements that's coming up from today's current circumstances. So you have to draw the line, fine line between facilitation and difficult economic circumstances, and at the same time not letting moral hazard incentives creeping into financial intermediaries. So this is what happened in the US prior to the global financial crisis. And this again, you see some crisis, financial crisis, not financial crisis, the banking crisis happened since 1970s all around the world. You see, there's systemic crisis that engage to some extent macroprudential solutions. So most of the places, the crisis that you are seeing here in red are contributed through systemic problems. That means the banks, financial intermediaries, they're linked with one another, and the troubles are not necessarily individual institution specific. Even in Sri Lanka, to some extent, it is not necessarily institution specific. To a great extent, it comes with the overall aggregate circumstances. It could be a kind of troubles related to terrorism, or for that matter, the market interest rates, exchange rates, economic downturns. That's all possible. These are systemic problems. Okay, non-systemic is blue, where it's not necessarily across the system, but various other elements. India had some crisis. It's not necessarily systemic, but to some extent, so-called a cooperative movement and saving movement troubles in early 1990s and mid 1990s in that part of the world. And of course, in the case of Australia and Canada, they had difficulties at times based on natural resources prices declining. There are some of the main exports are related to some of the natural resources. So these possibilities are there. But there are certain areas where you see no crisis, like green. That's not because no crisis, but no information, to be more precise. Insufficient information is yellow. That possibly due to standards considerations, where the available information are not necessarily comparable to some extent, and also compilation of that information had a certain type of problem. So you see different episodes across different part of the world at different times, and this also reminds you the fact that financial crisis could happen anytime, anywhere in the world. Despite you have all these regulatory measures, you have all these supervisory arrangements introduced, but still the challenge is huge in terms of preserving the financial intermediation and financial markets as a whole. Any questions? Please feel free to kind of clarify things if you have anything with respect to what we are discussing, because that is quite useful, not only for you, maybe others also might have in their mind, but they're not necessarily coming up and trying to kind of clarify things. But that would help you. That would help you to kind of ease the understanding and help everybody in the form of kind of getting the know-how into the areas that we are discussing. And here you see the cost of rescuing banks in number of countries at different periods of time. You see Indonesia during Asian financial crisis, 1997-2001 period. The cost of rescuing these financial agencies during that period almost cost more than half of their GDP. Okay, so it's a huge amount, more than half of the GDP to be spent on rescuing banks in Indonesia during that period. And see the Argentina, it's also more than half of their GDP during 80 and 82 period. And then Thailand that's again the same period where Indonesia had the Asian financial crisis, because in that mid-1990s, the Asian tigers, there were a few countries, Indonesia, Thailand, Philippines, Taiwan to some extent, they've been called Asian tigers. Malaysia also there in that equation, but seems Malaysia's case during the same period, the rescue package was not that big like Thailand and Indonesia. It's only about 16% of GDP in the form of rescuing these banks and financial intermediaries from these difficulties. But see, Argentina, then Latin American countries like Chile and Turkey, of course, had severe financial stress in the early 2000s. Yes, and then South Korea also part of this Asian tigers. Yes, during 97-98 period, 31% of their GDP being spent on rescuing these financial intermediaries. Okay, Israel had, then the other countries, they also have a different element of these crises, but Argentina is again repeating in early 2000s. And you can see even advanced economies like US, Sweden, Norway, all these countries are coming in, and it's repeating at different point of time, but the magnitude of these rescue packages are gradually shrinking in recent times, because there's the other elements, and the management of some of these banks in recent times is spread out to various other policy measures introduced by these countries, interest rates reduction, liquidity facilitation, quantitative easing programs. There are many ways through which these countries try to address so-called financial distress, bank panics during recent years. And then there see some innovative regulatory measures that's been brought in recent years. One is so-called Dodd-Frank bill and financial market regulation, right? So they are recognized that the financial regulation is tremendously undergoing changes with the financial crisis, and now with the COVID again, this has to be revisited on a continuous basis. But interestingly, this Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 being looked at as a very comprehensive reform package since 1930s, introduced in US. So that's kind of giving a lot of lessons for rest of the financial markets to see, and how best to fit things in today's financial intermediary considerations are looked at. And then of course this act looked at regulation from 5 different categories. That's why it's a future regulation direction. It says it's the act itself is a future regulatory direction. So you see, they look at consumer protection. That's what I was mentioning. Even Central Bank of Sri Lanka is introducing a new department to see financial consumer protection from Monday, 10th of August, right? So why they are moving in that direction is because now the importance of financial market consumer protection is enhancing. And this been recognized in 2010 Dodd-Frank bill as futuristic direction of financial regulation. And now it's been to great extent accepted by the countries all around the world. And then you see the resolution authority. So we also have departments now looking at, it's not only the supervisory and regulatory departments that they are overseeing financial intermediaries and their operation. There's a resolution authority. In the event of a problem, how to resolve. Okay, that's the way in which they would look at it in a different time. So you see the operations are expanding, right? So financial regulation is expanding into newest areas of consideration. I mean, it's not only the regulation, supervision, but resolution also. When a problem happens, how best to solve it. Okay, resolution and enforcement. These are the areas where they looked at from a very different perspective. Then systemic risk regulation. To some extent, macroprudential supervision is looking into this, right? So macroprudential, we said it's an aggregate system-wide risk elements being looked at. So the elements of macroprudential supervision is taking a deep kind of a sense into this systemic risk in today's financial market. So the Walker rule is interest rate or the money quantum based rule in Federal Reserve US Central Bank's monetary and financial market policy operation. So that also important, but this Walker rule is US specific, but the element here is you basically looked at interest rate guidance. So interest rates being guided by the regulators to direct and drive the financial markets into safety, if not safe landing from financial difficulties. And then, of course, looking at derivative instruments, that's what we looked at, all these new financial innovation, financial engineering, things like that we discussed in financial crisis lecture, where the expansion of assets classes by financial intermediaries, mainly based on introducing new products which are derivative based, which does not necessarily have underlying assets. Underlying assets have been widely spread across, and then CDOs. You all know how the financial products been established. So they are moving into these areas of important elements to address new lines of financial regulation. So these areas to some extent now been established in financial markets and still expanding in the form of new regulatory considerations. Please remember, these are new avenues of financial regulations now in discussion, and now many countries have introduced. Any questions on those? Right. So then you see new requirements we have looked at, but at the same time, regulations also heading into new future directions in the form of capital requirements that we have to some extent we have discussed these, but these capital requirements again expanding risk-based capital requirements in recent times. And this risk-based capital requirement again encourage financial intermediaries. Okay, you can have more assets, risky assets, but then you're bringing in a required basis. You can't just take the investments from all funds that you have pooled from third parties or depositors, or for that matter by indirect financing sources. No, you bring in direct financing sources also into the equation. So the capital requirement being enhanced and aligned with risk weights. So the risk weights being defined and expanding on a continuous basis based on market circumstances. And then there's the compensation policies. So you see the financial intermediaries often have performance-based compensation arrangement. The people work in financial intermediaries also knows their compensations would be linked to the many elements of performance. So they might necessarily move into so-called principal agent problems. They would take more risk than what they should be defined because their performance are compensated. But then, of course, these compensation policies also now evolving to great extent. Okay, you can have these profits, but these profits would not be distributed. This would be distributed across 10-year horizon, right? So you can make money, but that's not necessarily dispensed on the same financial year itself. So there are various ways through which, if not, they've been compensated in the form of they've been brought in as owners into the equation. So they are investments comes in as compensation here. So the compensation is their investments into the capital. So you see the way in which the arrangements are expanding. And then so-called GSEs, government-sponsored enterprises. So the so-called too big to fail is now being rearranged to some extent to say so-called government-sponsored enterprises. Those agencies being looked with some regulatory requirements which might not necessarily be generally applied across other financial intermediaries, because these agencies have the wide element of presence, because their activities are spread out into all spectrums of the economy, and also they are very big, must be having a very large market share. And looking at those stuff, of course, yes, that enhances the moral hazard side, but still they've been looked at with little caution and care because of the elements covers under the government-sponsored enterprises. And then, of course, credit rating. I was repeatedly discussing this at earlier discussions. The credit rating agencies is also very important in the form of a regulation in today's context, because credit rating agencies also sometimes act based on the established, if not even they could act based on general criteria as applied, but not necessarily very country-specific, system-specific consideration. And sometimes this might be a reason nationalistic requirements also required to be factored in today's context, because not necessarily countries are exposed to global market-based movements in economic variables, but also the political and social aspects, which also drives the economies to difficulties. So that's been also looked at in evaluation to great extent. And also the regulation have not been kept aside without kind of, seeing whether the agencies are over-regulating. So they are looking at whether there's a danger of over-regulation. So everybody is talking about regulation. Everybody is asking regulation. Everybody is thinking, okay, regulation would bring in a much more disciplined and orderly market circumstances, information symmetry. But unfortunately, the regulators themselves looking at whether the regulations are too much, because that kill the competition and that would not contribute to further expansion of financial markets and new financial instruments and innovation in the financial markets. So they themselves evaluating those stuff. That is also very important in today's context. So these are the areas into which you see the elements are now spreading into, right? So these two slides that we are discussing now is important, because these are the future direction of financial regulation. This future direction of financial regulation is very important, because this is evolving and to some extent applicable in today's context, where the entire financial markets, not only in this country, but all across the globe, is having difficulties with the COVID-related pandemic. So the COVID-19 pandemic has created a lot of stress across financial intermediaries and across entire economies, economic systems all around the world. So this would be very important for them to rejig to some extent some of these elements with health-related aspects also in today's discussion. So with that, we can conclude this section of regulations that we were discussing. Any questions? Right. So seems that you all not have questions. That means you have very good understanding of this area. That's good. And we can see the next slide. Next handout that's been shared with you all. I hope you have this slide. Yes, I think you have this presentation available with you, isn't it? You have this latest slide on banking industry structure and competition. Right. So we can introduce some of the preliminary concepts of the banking industry's structure and competition in this discussion. Okay, so you see here in this handout and in this section of discussion, the operations of banks. You look at individual banks here, and then you can move into a more broader aggregate environment. How they acquire, use, and manage funds to make profit. Okay, and it seems these institutions, individual institution, how the operations of these banks, on a broader sense, are roughly not different across different countries. That means they are reasonably similar across different parts of the world. Okay, and in all countries, banks are financial intermediaries earning profits. They keep the margins and they make profit, but that is like a margin-based business. But you see here in most countries, what they are simply seeing is 4 or 5 large banks, and sometimes it's not 4 or 5, maybe 2 or 3. Okay, so 1 or 2 in some cases typically dominate the financial industry. But in US, there's a significant diversified institutional structure, because they have not only the commercial banks, but also saving and loan association, mutual saving banks, that is unit trust and things like that. And also they have credit unions. But in countries like Sri Lanka, you might not necessarily see credit unions, mutual saving banks, loan association. Those are not that active. We are very much seeing commercial banks and specialized banks. They are also not different to commercial banks. Right, so these are the kind of main players in most of the countries. Okay, in this section, we start to look at the historical development of the banking system, and try to kind of understand how financial innovation has increased the competitive environment for the banking industry, and how it's changing the fundamentals in recent years. And also we will try to move into a commercial banking industry in detail, and try to understand the thrift industry, that is nothing but saving industry. Okay, particularly the environment in which the savings and loan associations expanded in OECD countries, and then to see mutual and credit unions, how it's works like. The commercial banks, to that matter, remain the largest depository institutions, okay, and often accounting for almost 75 to 80% of the deposits in the banking system, and it's now different in countries like Sri Lanka too. It's very much the commercial banks. But exception in Sri Lanka is you probably see National Saving Bank, NSB. That type of arrangements also promote savings, but most of the countries and all around the world, it's the commercial banks dominate the banking industry. Okay, so we also are looking at the growth of international banking system with some recent innovation in recent years, and these elements would help you kind of coin your answers and try to understand new concepts and short answers in examinations and things like that from this area of discussion, right? So the banks become reasonably started in UK, in England for that matter. Okay, so the idea of banks first started in Babylon. I mean, it's quite long before the Christ. In those days, it's looked like money lenders, right? They made loans to people, right? There were money lenders in those societies, so they had arrangements to extend some financial facilitations to people. And Greece and Rome banks had some experience of making loans and accepting deposits. Okay, they also made, I mean, they also changed money. I mean, that also they have done. But interestingly, money is not necessarily in the same form that you are now familiar and now using. So we can get into those as we move on. Okay, but with the collapse of Roman Empire, trade across Europe slumped to great extent. Banks also not necessarily that aggressive or existent in the picture. However, again, the banking revived in the 12th and 13th centuries in the Italia, where they see the Florence and Genoa had some banking elements. So the banks first started in England in 17th century. Okay, so it is not that historical as what you have seen in other parts of the world. Rome, Greece, and some part of Southern Europe. Okay, that's the history. But in England, it's in 17th century, and there are people at times deposited money with goldsmiths for safety. The goldsmiths not only did jewelry, but also they had some banking functions. People came and deposited their money, excess money, savings, whatever, with these goldsmiths. So these goldsmiths, in the place of these deposits, they issued a note promising to pay a bearer, whoever hold this note, right? It's not necessarily the original party. Okay, let's assume it's been issued to you, but subsequently it has been moved from you to one of your friends. So the friend who carries this can claim the sum referred in that promissory note from the goldsmith. So that itself a development where the note that the goldsmith issued has become an exchangeable good in the financial market at that time. Okay, in time, people began to exchange these notes instead of coins because it's what easier and safer, because you don't need to carry big notes and coins during that period of time, and they have deposited them with goldsmiths, and the notes they have issued been exchanged because it's safer and easier, right? So then these goldsmiths began to lend the money that they also, I mean, had with them in the form of deposits. Now they started extending this money to others for a return of interest rates. At times it's high interest rate. So they started kind of extending the deposits they had with them to the people who are asking financial facilitation. Okay, so they also paid now from the interest that they received from lending. They started paying some interest to people who deposited money in order to promote the savings. So people initially just saved with Goldsmiths for safe and easier facilitation. But now, not only for that, they're also getting an interest for their deposits. So that attracted more savings from people. Okay, so this was the circumstance in the 17th century in the UK. But this has expanded towards latter part of 17th century to early 18th century to establish the Bank of England. That was in 1694. So you don't think that Bank of England was there from thousands of years. No, it has established in 1694. Okay, so the basic idea of founding the Bank of England was to provide loan to the government. Okay, so in return, the Bank of England received 8% interest on loan. Okay, and also the UK government has extended the Bank of England the right to issue notes. On top of 8% interest received, they also had the right to issue notes, right? Because prior to that, in UK, the notes were issued not by the central bank, but by the commercial banks. They themselves issued. So at times they had differences in the currencies, but still they had some rights by private banks were issuing notes at that time. But the Bank of England was offered this facility. They were allowed to lend money and also buy and sell gold. On top of lending to government, they were given the right to issue notes, and also they were allowed to lend money to others in the financial markets, but also buy and sell gold. Okay, and this Bank of England is the UK's central bank, and it's situated down Threadneedle Street, and sometimes people call Old Lady because the Bank of England was there for quite some time now. Okay, and in 1833, right, then only the banknotes issued by the Bank of England were made legal tender. Okay, but prior to that, they were allowed to issue banknotes. Others also allowed to issue banknotes in UK. So since 1833, it's only the Bank of England started printing money, banknotes, and only the legal tender in the UK at that time. Okay, so we can move on to discuss the beginning of US banking. I believe this is an ideal point for us to stop today's discussion, and we will get back to this point in our next discussion next week. So if you have any questions, we can clarify. If not, we can start discussing from here next week. Right. So it appears that you don't have questions here. So we'll start from the US banking industry, how it started evolving and how it started developing from our next week's discussion. So we'll stop at this point and we'll meet next week. Thank you. Stay safe.